Welcome to The Rubber Meets the Road Economics, the podcast where we explore the driving forces behind today's economy and their real-world implications. Join investor Hunter Craig as he interviews Professor Edwin Burton from the University of Virginia, delving into the complexities of economics with clarity and insight. Whether you're an economics enthusiast or just curious about how economic policies affect your daily life, you're in the right place. Let's get started.
Welcome, Professor. Today is October 9th, 2025. Here with world-renowned Professor Edwin T. Burton from the University of Virginia. Professor, in the summer of 2007, 1 year before the Great Recession, you were talking about how the commercial mortgage-backed security market was locking up, similar to what you're talking about today, not in CMBS, but in other areas. What's going on in the economy, Professor?
The economy is clearly weakening, what we normally think of the economy. There's one exception to that, though, and it's a very, very big exception, and that's the artificial intelligence area, which has enveloped all the big technology companies, Meta and Google and everybody. The poster child is OpenAI. They're not a public company. They're a nonprofit, they claim. Sam Altman has also got the other problem. He doesn't have big cash flow coming in. He's not like Meta. Meta has $200 billion a year in cash flow coming in, so they can spend $100 billion. If he spends $100 billion, he's got to go out and raise it again because he doesn't have that kind of cash flow. So AI is the one exception. The economy, the Main Street type economy is weakening. There's no question. The number of jobs being created has fallen off to probably negative numbers. We're probably losing jobs now. There's been a reaction against government spending, and so a lot of that has slowed down. So the economy, if you forget about artificial intelligence, is definitely slowing. And honestly, it's been slowing for maybe 10 or 12 months. It's not something that just started in the last few weeks. It's been ongoing, but that's been masked by the tremendous capital spending going on related to artificial intelligence in two areas. One is in large amount of spending on things like NVIDIA chips and other chips. The NVIDIA chips are not the only ones being used in artificial intelligence. There are a whole lot of other different kind of chips being used. And those companies have been investing quite a bit to build more because they see tremendous demand. And then there are so-called data centers. And these data centers are not like the data centers of old. Data centers used to be just a whole bunch of disk drives out there sitting inside of a warehouse. The modern data center is very different. The modern data center is quite an elaborate operation. So that has required a huge amount of capital expenditures. And two things drive an economy, consumption spending and investment spending. Those are the two most important factors. Now, consumption spending has been slowing for quite a while, the rate of growth of consumption spending. But capital spending is bouncing all over the place. If anything, it's probably still rising a bit. And the announced plans are pretty high. But this all hinges on whether this is all capital spending or, to some extent, just expenses to be in the technology sector. Now, here's what I mean by that. Often you see people spending money on artificial intelligence, and it's very clear the way they describe it that they're playing defense. They're spending money on artificial intelligence because some of their competitors are spending money on artificial intelligence. If their competitors weren't doing it, they may not want to do it. And you saw a little bit of that from Apple last year when Apple retreated a bit from some of the artificial intelligence spending. But if they're spending it for defense, then they're not even thinking about new products. They're just thinking about preserving the products that they have by being able to tout that they have artificial intelligence. If that's the case, that's not capital expenditure. Those dollars should be expensed. That means earnings per share that are being reported is incorrect. And my guess is that's right. That if you look at the earnings per share growth in Meta and Google and all these people, they're capitalizing a lot of this expenditure on AI when it's not clear what capital is being built. Capital is irrelevant if there's not an eventual revenue stream. And it's very hard to find what that revenue stream is for a lot of the AI spending. I think that's what bothers folks like Dalio and Jamie Dimon and other people. Dimon is quite concerned that there could be a big sell-off in the stock market at some point here. He said so a couple of days ago. And I think what worries him is there are two kinds of people who are arguing that artificial intelligence is the wave of the future and deserves any kind of valuation. whatever, no matter how high. The people that are selling things based on artificial intelligence, I mean, if you're making chips, obviously you want to talk up AI. You want to talk about its future and all that. Or if you're developing a startup that's going to use AI to build consulting chats or something like that, then you want to talk about AI. And you can see those people every morning on CNBC and other financial news networks talking about how AI is the wave of the future and it doesn't matter if we can identify the products. So they have a vested interest in promoting it. The second group, I would say, are people that know nothing about AI. A large number of people rarely, if ever, use artificial intelligence. They're not very familiar with any of the models. They may occasionally ask ChatGPT what the weather's like or was like yesterday or something, but it's not used in their everyday activity. Now, I use it in my everyday activity. As you know, I design my course websites using Claude, which is Anthropic's artificial intelligence large language model. And I use ChatGPT to design a lot of things, to design my courses, my syllabi. I use it often to find data. I'm a regular user of artificial intelligence. It's pretty clear to me that while I use artificial intelligence and it's helpful to me, it's helpful because I can do things a little bit quicker. But if you think this thing doesn't make mistakes, there is no artificial intelligence product I've seen that doesn't make a lot of mistakes. ChatGPT makes tons of mistakes. By the way they're constructed, they're guaranteed to make mistakes. So it can't really replace a human being, at least in the oversight. So the idea that you can just come in and replace all your employees, all your investment bankers go away, all the lawyers go away, just turn it all over to a machine, maybe that's out there, but it's not here today, that's for sure. These large language models make a lot of mistakes. And a poster child for that is Taco Bell. Taco Bell installed in 500 of their stores a large language model to take orders and decide what to give customers. And it turned out it was a colossal failure, and they had to pull it from 500 stores very quickly. And it makes you wonder, did the management of Taco Bell understand that large language models make mistakes? A lot of these people that are talking about how great it is now, there's been so few implementations of it anywhere. So I'm just saying we're at an early stage of all this. And if you're going to spend hundreds of billions of dollars on a model that's making lots and lots of errors, and the improvement rate, if you look at ChatGPT 5.0 versus ChatGPT 4.0, people in the industry say it could be worse than 4.0. So I think there's way too much hype going on in artificial intelligence. Very little identifiable new revenue sources for companies that adopt it are expense reductions. You have to either improve your revenue situation or lower your expenses to justify the capital expenditures. What's Meta going to do? Are they going to find another billion customers somewhere once they spend all this money on AI? What exactly are they going to be able to produce doing all this? Is Apple going to be able to charge $3,000 for an iPhone because they spent some money on AI? How's AI going to help you make a phone call? Well, maybe it will. Maybe AI can dial it for you. Heck, maybe instead of spending $3,000 for an Apple phone, I'll buy my own phone number for $500. Who knows? But that's the problem now. All of this is treated as if the capital expenditures that are just enormous are going to create new products. And that remains to be seen. Might happen, but it might not happen. And if it doesn't happen, then those earnings per share numbers that you've been looking at in Wall Street, the earnings per share, it's unbelievable. If you took AI out of the S&P earnings per share, it would drop in half, more than half. The technology companies are the big source of earnings in the S&P 500. And those earnings depend critically on capitalizing this massive expenditure. But at some point, there better be some revenues or some costs that can be cut. And I'm dubious about that.
Recently, Ken Griffin, Paul Tudor Jones, Ray Dalio have expressed concerns about the economy. Ray Dalio went so far as suggesting that investors increase their allocation in gold. First Brands recently filed bankruptcy, as well as other companies. Are there data points in these bankruptcy filings that would give us indication of what's going on in the economy? You were so dead on in the summer of 2007, predicting the next year or two. Are there any hidden data points or takeaways that we can glean from these bankruptcies?
Well, there's a lot of hidden distress because of what's happened in the debt market over the last few years. Financing for a long time in the U.S. economy was pretty cheap. We had very low interest rates at every level, for not only home mortgage rates, but commercial lending rates. You could buy buildings and finance them on a 5-year basis at very low numbers, even through residential mortgage rates. And I think there came a time as businesses were starting up 5-6 years ago that people initially got their money in a low interest rate environment. And ever since that, every time they try to refinance, they're facing staggeringly higher interest rates. And a lot of the business models weren't geared to work at higher interest rates. And I would suspect if you look at some of these bankruptcies, that's a bit of what happened. And of course, there could have been some disappointment with their revenue streams also. There have been 4 recent bankruptcies of note. Tricolor was the first one that was announced, but there have been 4, and recently the First Brands, I think, was the one announced a day or two ago. But it's not just all in the auto. Those are auto sector ones, but there's one called At Home that came out a couple of days ago as well. I think these bankruptcies show that we're in a higher interest rate regime than anyone expected 5 years ago because of the long period after 2009 when rates were very low and financing was very low. I think the biggest problem is when you have a slowdown, rates are supposed to go down. Well, they haven't gone down. The deficit is still running 6% plus. It's probably going to get worse, not better. Rates aren't coming in like they had hoped. And financing is still tough. Auctions are still not good. So the economy is struggling, and all this tariff craziness doesn't help. The administration's tariff policies were originally, I thought, supposed to be to make U.S. self-sufficient or this or that or the other. But it's gone way beyond that. Now it's to punish this country because they did this or that or whatever the president wakes up thinking that day. Tariff policy is just completely chaotic. And if you're a business that depends on importing raw materials or intermediate goods, not only in the U.S., but anywhere in the world, it's a nightmare to deal with the chaotic tariffs of the administration. Just yesterday, they announced a new tariff on trucks of 25%. And these are not tariffs where they go from 0 to 5%. These are from 0 to 25% or 0 to 50%, which is enough to end your business. And if you're in the car business in this country, oh my goodness, it's really a nightmare to figure out what to do. So all of those things combine to weaken the economy. But what keeps us going is AI. Let me say one more thing while I'm on the subject of artificial intelligence, because I think people don't understand the economics of these companies very well. In the very end of the 20th century, that's when we had the internet bubble and all that. The companies that failed, and when they failed, there was nothing left of them. You know, they had an idea, they put it on the internet, it never got anywhere, and their funding ran out, and poof. And when they went away, there wasn't anything left. It wasn't like they were building baseball bats, and when they went away, there was a whole bunch of completed baseball bats sitting out there. If there were, somebody else would have come and bought the baseball bats and just revalued them down. That's what normally happens. You build a product, it doesn't work, but you go bankrupt, but then the next buyer, it works for him. That's the way it should work. You just valued it too high, but there's a real product there. That's true in artificial intelligence. You've got 14 American companies, at least that many, who now have a large language model. They tend to work about the same as you go from one to the other for most purposes. If those companies go bankrupt, that product will still be there. It'll just be revalued and sold to somebody else. So you're going to end up with a competitive environment in large language models, even if some go bankrupt. That product doesn't go away. ChatGPT will still be with us even if OpenAI goes under. Somebody else will just take it. So it's not like the dot-com bubble where there weren't really businesses often. People would put up a shingle and say, give me a whole bunch of money, I have a dream, and people would give them money and they'd dream, but nothing ever happened. They just dreamed. Nothing ever got built. That's not what's happening here. You're building data centers, you're building large language models. There are real products. They just aren't worth what people say they're worth. And so they'll get all revalued down. And I think that's what's really worrying Dalio and all the other people is that these valuations, don't make any sense, and they don't make any sense. There are not enough people on the face of the earth and enough energy on the face of the earth, well, never will be, to fuel all this stuff. That doesn't mean it's not worth something. It is worth something, but it's worth a fraction of what people think it is. And I think that's where this is going. AI is very valuable. I'll use it. I'll always use it. I think it's really changed things for a lot of businesses and companies. But it hasn't changed. It's not a bigger event than the internet at all. And people are saying it is, but it isn't. And I think you'll see valuations in that space collapse.
Federal Reserve meets in 20 days. Yield on the U.S. Treasury 2-month is 4.04. Widely expected that the Federal Reserve will lower interest rates on October 29th. What do you think, Professor?
No, just keep watching the bills. Bills will tell you the answer.
But which bills would you watch?
I'd watch whatever's still left out there. 1, 2, 3 months would be the ones. And if they're right at 4, then the Fed, what they would do in practice is they would instruct the New York desk to set up a reverse repo facility and push those bills down. In other words, they'd come buy bills and then repo them out, and that would push those yields down under 4 if they were determined to lower the rate. The problem with that is that could become public. People know when they do that. I think the Fed likes to live in this world where it's what they say, not what they do. In other words, if they just say it and then the markets move, but I can tell you logically why that can't be the case. At any one moment in time, there's a supply and demand for repos or Fed funds, if you like, whichever. Repo market's way more important. If you could do that, let's say the Fed could say, okay, well, let's just take the repo rate down to 3 3/4. Just saying it. You haven't changed the supply and demand. And unless you actually do something, it'll go right back to where it was. It's like saying, I want cars to sell for 20% less than they are next week. Maybe they will for a moment, but if the supply and demand of cars hasn't changed, it'll go right back to the price. Markets work. So the idea that the Fed, just by conversation, people often say, well, it's because they think the Fed has the power to do it. They do. But if they don't exercise that power, the market will just go right back to where it was. And I think people in the Fed won't admit it, but I think they must instinctively know that unless those bill yields are below 4%, they can't lower that target rate on the repo market for pure arbitrage reasons. But I wouldn't be surprised if they decide to do the reverse repo. Now, when people look at the Fed balance sheet, they don't notice the reverse repos because they don't show up on the asset side. So if the Fed is buying bills effectively through the reverse repo, that shows up in the liability side of the balance sheet. So it has no impact on the balance sheet. So people will say, oh, well, they're reducing their balance sheet. No, not if they're doing reverse repos, which effectively means they're buying bills. It's a technical point, but the Fed is a master at obfuscation. It's supposed to be a transparent central bank, but it isn't really. So my guess is unless the bills start coming in more, they're not going to be able to do a 25 basis point increase. But I don't want to make that prediction now. I want to see what happens over the next few weeks. You can't predict this far out. There's certainly no economic reasons for the Fed to do much of anything because the economy is still clipping along at a pretty high rate. So if they do what they say they do, and what their real mission is, inflation's still out there. And it seems like it's glued up to 3%. Their target's 2%. So if they're being honest with themselves, inflation's not over, so it's a very bad time to be lowering rates. And the chairman has not said the economy is in bad shape. He always, in fact, over and over again, keeps saying the economy is in a good place. Those are his exact words, matter of fact. So if the economy is in a good place and inflation is too high relative to their target, what's the argument for cutting rates? Nothing. And, of course, there never has been. The reason they cut rates last time is the bill yields had already gone down. If the bill yields slip below 4, if they go down to, say, 380 or something, or 390, then they'll cut rates regardless of the conversation, regardless of the inflation data, regardless of the GDP. None of that makes any difference. This is a huge market. Here are some numbers. How big is the Fed funds market? How big is that market? $5 billion a day. That sounds like a big market. What's the size of the repo market? $1 trillion per day to $4 trillion per day, depending on collateral. The repo market is what matters. Fed funds is almost completely irrelevant. In fact, the repo market is the largest competitive market in the world. There is no financial market as big. The stock market is a third of that, actually less than a third of that. Stock market's a peanut market compared to the overnight repo market. That's the real market. And it's a competitive market. And the idea that some wizard sitting behind a green curtain can decide what the rates are is ridiculous.
And who are the players in the repo market?
Every single bank, commercial bank, the University of Virginia, they're in the repo market. Harvard, they're in the repo market. They probably do $1 billion a day, maybe $2 billion a day. UVA probably does $500 million a day in the repo market. Everybody, it's the overnight lending market for cash. If you're a little bit short of cash, you've got a payroll coming, you don't want to do a bond offering, what do? You go into the repo market and borrow the cash, and away you go. Or you've got excess cash, you don't have time to figure out what investment to make, what do? You go into the repo market. You invest in the repo market, you hold cash, government collateral. That's the way the repo market works. That's why it's the largest market in the world.
If a university borrows, what do they provide as collateral?
Treasuries. The university has plenty of U.S. treasuries, believe me. Everybody does. Who doesn't have U.S. treasuries? Name somebody who doesn't have U.S. treasuries. They have treasuries, and if you've got treasuries, you can borrow at the overnight repo rate. There's not a company of any size in the world that doesn't access these markets. Nobody, and certainly no one in the U.S. They all access these markets, but other countries have the same kind of facilities. It's just the American one is the most efficient. Now, the stock market, maybe it does $300, $400 billion in a day. Fine. And the repo market does between 3 and 12 times that much every day. It's not even close, which is the biggest market. So the very idea of this Wizard of Oz phenomenon controlling the rates honestly makes no sense. And if you just look at the bill yields, you yourself get within a week of the time you can predict it. Now, if it's just sitting right at 4.0, it's going to be tough to predict. But here's my guess. If the bill yields are all right at 4.0 when we get in close to the October 29 deadline, they'll use the reverse repo facility and force it down because politically they're dying to get the rates down. So Powell would like nothing better than to get the rates down, and same with the committee. Why is that? Because lowering rates is always more popular than raising rates. The world wants lower rates. You talk to people all the time. Who's yelling for higher rates? Who's dying to see higher rates? I haven't met that person. Everybody wants lower rates. So if you want to be popular, lower rates.
The U.S. economy in the 1970s suffered greatly from stagflation. Is the U.S. economy today in a state of stagflation?
Yes, I think that's pretty accurate. Now, inflation could go away. My guess is it won't, because there's going to be so much pressure on the Fed to keep rates below where they ought to be that they're going to have to expand the money supply to do that, either through using the reverse repo facility or just outright purchases of bills and notes and bonds. So my guess is the Fed will come under increasing pressure. The administration, for example, thinks that it can finance this 6% deficit if it could just get rates down to, what the president say, 1% in the repo market. Okay, if it's all 1%, yeah. This year, the interest charge on the national debt is running $1 trillion. That's the running rate for interest on the national debt. If he could get it down to $300 billion by miraculously lowering all the rates to 1%, why, he would do it. And I don't know if Trump knows enough economics to know that that can't be done without massive inflation, which means much higher rates later.
And $1 trillion is more than we spend on defense?
Oh, yeah. We spend about $800 billion on defense. But when we had this conversation 3 years from now, Hunter, you're going to wish we could say it's $1 trillion. That number is going up for the same reason all the numbers are going up. If you ask yourself, where's the 30-year bond today? And then you ask yourself, where was it a year ago? Which would you think? You think the rates are higher today? Yes, they are. Now, the 3-month bill might be lower, but the 10-year yield and the 30-year yield, they're higher than they were a year ago. So what does that mean? Well, those are Treasury obligations, too. So the market controls these rates, not the central bank. And when the central bank tries to control them, particularly if they try to lower them, all they're going to do is cause inflation, which long run raises them. That's Turkey. Go read up on Turkey. Turkey early on decided he was going to lower rates. So what did he do? He told the central bank, lower rates. So they entered the market, bought a ton of Turkish sovereign debt. And that was great. Rates dropped for a month. And then inflation took off to 100%. And guess what happened to interest rates when inflation went to 100%? They went right with it. And so you went from a regime of moderate interest rates to the highest interest rates in all of Europe. Turkey is not in the Eurozone. The Eurozone is lucky to avoid that. Let me mention, by the way, one other subject, which is going to be on the news. France is running about a 5% deficit. That's well above the Eurozone's 3% rule. So the question is what's happening, what's going to happen. French government has, roughly speaking, failed. Macron will not call a parliamentary election, although he probably should. The right policy, and people will disagree with this, I can just hear people scream when I say this, they should let France go bankrupt. And of course, if that happened, then Italy would go bankrupt. And I think that's all for the good. What's happening now is everyone assumes Germany will bail everybody out. So all the interest rates are pretty close to one another. So instead of truly reflecting the financial peril that France is in, their rates reflect the fact that there might be a German bailout hiding underneath it. And that's eventually that's going to blow up the Eurozone. The reason the U.S. works is if some state spends more than it could, it goes bankrupt. And cities do too. Detroit's been bankrupt 3 times in the last 100 years. Bankruptcy is not a new phenomenon. We don't bail out cities and states in this country. And Europe should stop bailing out countries because it gives them incentives to do worse. If you bail out France or leave the impression you're going to, what's France going to do?
What happens to the French debt if they're not bailed out? Does all the debt just get repriced and remains, but at a lower value?
That's right. That's what should happen. I mean, if you're a country running 5% deficits, your interest rates should reflect that. They shouldn't reflect the interest rates that are for a country that's not running 5% deficits. But once Germany stepped up for Greece, which happened a couple of decades ago, that was a terrible mistake. Merkel stood up and said Greece not going to fail. They were worried that Greece would leave the Eurozone. That's what they were concerned about. They don't have a provision in the U.S. A state can't leave the U.S. when it goes bankrupt and print its own currency. But in the Eurozone, they could. But the right policy would be to say, no, you got to stay in the Eurozone. You just got to go bankrupt. I mean, who would that hurt? Who owned Greek debt at the time? Hedge funds. You don't want a single drop of Greek debt held by a pension fund in Europe or America. It was held by hedge funds. They came in and bought it at 30, 40 cents on the dollar. And when Germany stepped up to bail them out, they made a fortune. It's a great trade for the hedge funds. And, the same kind of thing works with France. If France got in trouble, guess who the buyers would be? The hedge funds would all go in, look at it and say, oh, well, Germany will probably be forced to bail them out. And Germany would. And as long as they keep doing that, you're going to endless cycle. And so Europe's got an ongoing problem. They have set the system up so that there's an incentive to run large deficits. And they are doing it. The U.S. is a little bit set up that way because we believe that the dollar dominance, dollar is the primary means of settling international transactions all over the world, except within the Eurozone. Within the Eurozone, they use the euro. But outside of the Eurozone, the dollar dominates transactions, even in places you wouldn't think, even between, say, China and Vietnam and places like that. The dollar is still the means of transactions. And so Americans rest on the assumption the world needs us. The world is increasingly beginning to wonder whether they need us. And that's a problem. And you can't run the size deficits we have. There's so many different subjects all buried into this. Healthcare expenditures, the problems with Obamacare that are coming up, which is the source of the government shutdown difficulties. All of this is because countries are living way beyond their means. It's a common global story.
Volatile times, Professor. Thank you. Fed meets October 29th. That's a big day. Thank you, Professor.
Thank you.
Thank you for joining us for the Rubber Meets the Road Economics podcast. If you enjoyed the discussion, remember to subscribe and stay updated with future episodes. Join us soon for more conversations about modern economics on the Rubber Meets the Road Economics podcast.